wars, geopolitical tensions and sticky inflation. For more on this, we're joined by Nour Hammoury, Chief Market Strategist at SquaredFinancial. Good to have you on the programme with us, Nour. Now, let's start with these tariffs. The 90-day pause is set to end on July 8th, and markets are optimistic over the White House's comments. Do you think this is the case?
Definitely, that's definitely the case. I mean, we've seen the markets basically recovering since what we saw back in February because of the trade war from one side, in addition to all the retaliation that we saw from the U.S. or from the other all over the world. But the question would be now we are optimistic because of the deals, but little do we know that there is at least, if you're looking at the deal that the U.S. announced between the U.S. and China, there's still a baseline of 10% tariffs on the majority of the products, meaning that inflation is still, or the inflation risk is still on the upside. It's not on the downside. Yes, so far we haven't seen any kind of indication that inflation is going up. Inflation expectation is up, but inflation itself remains basically on trajectory to the downside. But I think this will basically change over the next few months. Yesterday we saw also another set of data that basically showing that tariffs are not basically helping the U.S. It's basically on the other side. We had exports basically down by 5%. That's the biggest drop in about 3 or 4 years. In addition to that, even imports last month we went down by 30%. That was the biggest decline on record. So consumption from the other side is good, but it's not good enough to offset also weaker growth, which is, again, at some point, this is why the Federal Reserve is very reluctant when it comes to cutting rates. But markets are still optimistic, yes, but we have to look forward how the market will basically react going forward when it comes to more fundamentals in addition to corporate earnings.
Right. Meanwhile, China's industrial profits plunged more than 9%. How much of that is down to these tariff fears?
Most of what's going on right now is basically because of the tariffs. Because before at the beginning of the tariffs, basically you have to understand like how basically the industry works is before the tariffs were implemented, we saw a huge spike in industrial productions. We had a huge spike in exports, even to the U.S. or even to Europe. A huge imports, and now we're going back down because there's a lot of a future unloading before they basically before the tariffs went into effect. So now we'll have to see for the next few months how basically this continues, if it's going to be a sustainable some sort of growth, or it's going to be basically on the downside. But I think this is at some point it will basically the market and the economy will adjust to that. The biggest question remains here. Is this going to be the same as what happened after the first trade war when Donald Trump basically also added tariffs on China and many other countries? And is it going to happen again? I think it will, but the difference would be now maybe central banks will be more aware of it, or maybe more planning forward to what could happen over the next few months.
You mentioned the Federal Reserve being reluctant to cut rates, but with the pressure from President Trump, are markets expecting more cuts than initially projected?
I mean, the Federal Reserve is independent. Yes, it might be a little bit influenced sometime by some politics, but it doesn't mean that whenever the Federal Reserve or whenever the president says you have to cut the rates by 1%, you have to do it. I mean, Donald Trump is asking the Fed now to cut the rates by more than 100% or 100 basis point in one decision. We haven't seen such a thing before, unless if we're in an economic crisis. That's number one. And number two, even when Trump kept saying that he will basically be firing Jerome Powell, legally he can't. He's talking about it, but legally he can't basically fire Jerome Powell. But at the same time, now he's talking about who's the replacement, and there's about 3 to 4 names, and these names are basically the most maybe dovish names, which that's one of the reasons why the dollar went down over the past few days, because markets are now forward-looking who's the next Federal Reserve chair, and most likely the next one will be in line with what the president wants, which basically cutting interest rate. The current chair is with cutting rates, but he's saying basically one of the things: if we do a mistake now, generation or future generation will be paying the price, and he's not wrong about that, because it's becoming now very close to as if we are in a kind of a stagflation, which is the risk of stagflation is high. So he doesn't want to basically make a major mistake right now, and it's much better to be waiting for further data. That is not this is something that everybody is basically agreeing on. But going forward, I think Jerome Powell, once his term ends at the beginning of next year, markets will be already pricing in what the Federal Reserve will be doing going forward.
Nour Hammoury, Chief Market Strategist at Squared Financial, thank you very much for your analysis.
Thank you for having me.
Now, talks between French unions and employers over pension reforms have reached a deadlock. 2 years ago, the government